Storms in Melbourne and Perth this year created chaos for hundreds of people. It's also severely damaged insurer IAG's bottom line. The company posted a $91 million profit today, down from $181 million a year ago. It wasn't helped by the disastrous UK business, which has made substantial losses. A short time ago, I spoke with Mike Wilkins, the CEO of Australia's largest insurer. Mike Wilkins, thanks for joining Lateline Business.
It's a pleasure.
While the annual result is in line with the profit warning that you issued last month, it is a disappointing result for some. Where do you see improvements?
Well, Bridget, we're very happy with the underlying performance of our business, particularly our home territories of Australia and New Zealand, which have shown considerable improvement in this year, and that built on the improvement from last year. What was a disappointment to us was the issue that we had in the UK around bodily injury claims experience, but we believe that we have adequately dealt with that, and we're now looking to a better future.
The UK business, it's very competitive. It hasn't been performing well. What are you going to do about it?
We've taken a number of remedial actions to address the issue in the UK. We've immediately put our prices up between 10 and 20% across all classes of business. We've looked at the broker relationships that we've had, and we've dropped about 8% of those brokers who are giving us poor quality business, as well as putting in place remedial actions for a number of other brokers. In addition, we've stopped accepting motor and van business off aggregator websites, as well as ceasing to do business with the 4 largest aggregator brokers in the UK. So significant remedial actions which we believe will deliver a better result in 2011 and more particularly in 2012.
But by putting your price up, couldn't you be pricing yourself out of the market? It's extremely competitive. There may be some shareholders that might be thinking that you're best to exit the business.
Our concentration at the moment is on remediating the business that we have in the UK. We always prefer to get the correct price for the risk we're being asked to take rather than trying to continue to hold top-line numbers. And certainly we've said for the UK for 2011 we think that our gross written premiums will be flat at best.
In regards to Australia and New Zealand, things have been performing better there. What are you going to be doing in the next 6 to 12 months to improve things even more?
We're continuing to look at the product sets that we have and the features that are in those products, as well as looking at our own internal processes and the way in which we engage with our customers, because at the end of the day what we're seeking to deliver is the best customer experience that we can.
What about the commercial insurance market? That hasn't been performing as well as other areas.
The commercial insurance market in Australia remains tough. There is plenty of competition there, and what we've preferred to do is to actually get an acceptable price for the risk that we're being asked to take rather than just continuing to protect our top line. We saw modest GWP growth in our commercial business in Australia, but more importantly to me was with the remedial actions that we've taken, we've seen a $50 million improvement in the underlying performance of that business during 2010.
But as you mentioned, if that's going to remain competitive, what strategies do you have in place to help that area lift its game?
We're continuing to look at our internal processes, but we do expect that it'll be a tough market into 2011. But I do think that the investment that we're making in the business, in the product sets, but also in the way in which we engage with our customers, will see an improved performance from that business in 2011. And
what's your forecast for 2011?
Overall, we're forecasting an insurance margin for the group of between 10.5% and 12.5% in 2011. That's on the basis of an increase in our gross written premiums of between 3% and 5%. But having said that, obviously it's subject to caveats that are normal in this industry around natural perils being in line with our allowances and no material movements in exchange rates or investment markets.
Mike Wilkins, we'll leave it there, but thanks very much for joining us tonight.
Thanks, Bridget.